Happy New Year! Despite all negative economic predictions from the year before, the stock market was resilient. While both bonds and stocks moved simultaneously downward in 2022, we saw a similar move this time, but in the opposite direction, especially when the Fed kept rate at 5.5 starting July onward. Between July and October, yield rose as high as 30% yield to date for longer-term bonds, reaching as high as 5% for the 10-year and 5.4% for the 20-year Treasury. However, this yield quickly dropped as price rose as a result of demand increase after the Fed opted to keep the rate stable for the rest of 2023. All sectors in the S&P 500 closed this year positively, except for energy that closed it flat and utilities that retreated by 8%. Notably, the top 10 names in terms of market cap now make up to 34% of the entire index. These names are like Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Berkshire Hathaway, Tesla, and Lilly as well. Notice the heavy tech concentration compared to last year. Back then, the top 10 names made up only 28% of the index and included more names from healthcare and energy sectors. Unemployment remains low at 3.7%. However, unemployment by education segment paints a different picture, especially when seeing 6% unemployment for labor force without high school diploma, compared to 2% for the bachelor holders. On the other hand, we are seeing lower participation rate, signaling shortage in labor supply, which may lead to increase in labor costs if no reversion takes place. Finally, inflation expectation as well as both CPI and PCE metrics also shrunk, with November headline at 3.1 and PCE headline dropping below March 2021 level of 2.64.